I'll give you all a countdown.
Good evening, ladies and gentlemen, and welcome to another webinar by Axis Mutual Fund. I am your host for today, Siddhanta Proy. We are in the midst of a global boom where we see the likes of Amazon, Facebook, Google, Apple, who have ingrained themselves into our daily lives. Therefore, we are here to talk about a new product that we have to offer called Axis Nasdaq 100 Fund of Fund. We have with us today Shikha Vageria, a senior product manager with over 7 years of work experience. And with Shikha, we intend to understand how we can have these cutting edge companies a part of our daily lives and therefore grow with them. So, without further ado, over to you, Shikha.
Thank you, Siddhant, and a very good afternoon to everyone. Thank you for joining us today, and hope you all are doing very well. I'd like to start this session with a small activity, wherein I just want you to reflect back, like what all you did since morning. Like you woke up, you got ready, you went to work, you did some work at office, and now you joined this webinar. If we look at the detail of each of this activity, you realize that we are all bounded by the technology there. We have seen that every aspect of our life is influenced by the technology. We woke up by full alarm. Then we check our mails, our messages on Facebook, WhatsApp. We go to work, we use the Google Maps. We reach work, we use the biometric systems, we swipe our cards. We use Outlook, Gmails, presentations, Excel sheets, and then finally we logged into a webinar. All this, are some aspect connected to the technology part of us. And if you look back like 25, 30 years back, we can't even imagine, how life would have been that time without using a phone, or how people used to work without Excels and PowerPoints, how cars used to be, and how people work without Google search. Now, how do they get day by day by? That's the main thing, that we have gone so much into technology, and with that, the adaptation factor is also paced up a lot. We're adapting to the technology much faster than what we did earlier. We know that we'll adapt the metaverse very quickly. We know that we're going to go with the self-driving model very quickly. And not just the regular aspect of our life, but if we see the health aspects also, there are a lot of companies which are going into robo-assisted surgeries. There are companies which are developing more medicines, doing more technology in that. So all of it, we know that we're going to benefit out of it in our life. And with that thought, okay, why just benefit it in our life, and why not our pet portfolio should get benefit out of it? We are coming up with the excess fund of fund, that is Nasdaq 100 fund of fund. The NFO is going on, and it will end on 21st October 2022. As the name suggests, it access Nasdaq 100. So let's understand first and get into detail of what is Nasdaq 100 is. Nasdaq, as I talked about, it's about the companies which are going towards the disruptions, which are the game changer in technology. Just for an example, let's say Google or let's say Apple, they are all the game changers. They're all the forward thinkers there. So these are the companies which are influencing our life daily. So that is where Nasdaq 100 is placed. It's 100 of the largest non-financial companies here. When I say non-financial, I really want to emphasize on it, because if we look at our portfolios right now, whether we have any fund in it, whether it's the individual stocks or it's an index, you will realize that exposure to financial companies are very high there. If you pick up any Nifty 50, you pick up S&P 500, you pick up your individual scripts, you know you will have bank exposure in it. You know the funds which you invest in have banks and financial services as the highest exposure to it. So overall, they're all financially exposed indexes or funds. But they are not just the financials which are taking the world ahead. But if you actually see, the economies are getting driven by the new sectors. So like technologies, like healthcare, all these are playing major roles there. Your GDP contributions by these sectors are increasing day by day, as well as the companies which are high growth and innovative large cap makes the part of Nasdaq 100 there. When I say innovative large caps, that are the companies which are doing a lot of on the AI sides, BI sides, or are doing a lot of on the clean energies. a lot of influences from the tech savvy companies or the tech advanced companies, we could say that. And being this a Nasdaq 100, it's going to give you a global exposure. So it's a US based index. And hence, there's a need of the diversification, which we always talked about. So, whenever we talk about portfolio, we always talk about diversification there. But the home biasness come inside it, like doing Nifty 50, doing Nifty mid cap 100 types. But a geographical diversification is equally important in that aspect. And hence, the entire package of Nasdaq 100 gives you this benefits. If I talk the details of this fund and get into detail of what Nasdaq 100 comprises of, so you could see a sector breakdown here. So when I said it's a part of a non-financial companies, we can say what comprises of it then. If it's not financials, then what it is. It's informational technologies that take 50% of it. It's consumer discretionary and communication that takes 16% each. So when I talk about IT here, IT is not earlier used to be just hardwares and equipments, but in the current scenario, IT is not just the hardwares, it's softwares, it's services, it's cloud. So it comprises of a lot of stuffs which you talk on day-to-day basis or which are influencing your life on day-to-day basis. And these are the sectors which are actually getting into the new economic sectors there. So IT contribution to the US GDP in 2010 has increased by 95%. So assume that in 2010 GDP contribution was X. Now it's 95% of that X contribution to the GDP. Similarly, 20% is from the healthcare has increased from the healthcare. So these are the sectors which are the new economic sectors which are giving more to the GDP and which will continue to give more to the GDP there. So hence, if you want to go with the growth of the economy, so if you want to go with the growth, these are the sectors which have the major contribution there. These are the sectors which are getting major disruptions also. So let's see, if I talk about the top 10 years, you know that Apple, Microsoft, Amazon, these are the major disruptions. They have disrupted some of the technologies before and come up with the advanced version and captured the market there. If I have to talk about here more on in details here, it's not just the top 10 here, but also if I see that there are companies like Autodesk, which is part of the Nasdaq 100, which is a pre-packet customer services. Software services, which helps in advancements of engineering and architecture softwares. And again, these are the disruptive companies, which existing technologies are getting disrupted. They're making advanced packages, and hence that's how they are growing here. So that's basically the comprises of the constituents of these indexes. If I look into the little detail on it, that this constituents when I talk about when this you see these companies, one, they are the global, they're not just the US based here. So when I said global, I mean that though they are domiciled 98% in US, but their revenue generation is just 50% from US. And rest 50% comes from the rest of the world. It comes from Asia, Europe, Latin America, Middle East type of. So the concentration is not just the US economy there, but the concentration is the across the globe here. Majorly why it comes to 98% US is that a lot of companies which are not home for the US but have actually gone to the US index and registered themselves because of the ease of capital and the more capital intensive the US is. And hence the business domicile looks 98% there, but the revenue generation is across the world. When I talk about this revenue generation here, the global exposure here, there's a further detail. If I go into this index, I'll see that it's not just the IT, it's not just the communication, it's a broad theme which this index is gone around with. For example, AI, big data, robotic, cybersecurity, clean energy, clean economy. So when you divide this entire companies into different themes, you will see that has a broader exposure on it all. And all these exposures are something which we talk about day to day, or which at the global level are getting discussed. Like it's the artificial intelligence, we talk about clean energy, we talk about green economies, we talk about robotics taking it. So all this are getting talked at the global level. So we know that these are the areas which are growing in the world. If I further bucket it down to see that which of these themes fall under the disruptive technology here, 86% of the companies of Nasdaq 100 falls under the disruptive technology, and 14 are the other thematics there. So just to give you an idea, like what this index comprises of, it's a non-financial index. It has covered a broad aspect, and each aspect of this is concerned with either disruptive technology. All of these companies are the forward thinker. All of these companies are something trying to do in a game changing in the economy. So exposure is quite wide here. Coming down to this exposure, so when I say that they're disrupting technologies, we know that one of the important things to do that is have to do spend a lot on research and development. And how do I prove that they're putting more into research and development there is to see that what patents they have. So if you see their May 2007 patents is 19, and now it goes to 207.9. It's a US billion-dollar number. So 10x time of investments in the patents are there. It means they're developing more there, and they are putting more and more advancement there, which is getting patented there. To further see it in comparison, because this is an individual number, if I look into comparison with S&P 500, which is another US-based index, then it says it's 3.5x time more spent than the S&P 500, which is 500 companies, and Nasdaq, which is 100 companies, spending 3x times more on it, which itself proved that these companies are spending a lot on research and development. It means that they will have more advanced technologies to give you. This is about the index here, so that you know how it comprises of. But the most important part, I think we all are concerned about, is how it has performed across. So if I see the performance, it's a year-on-year performance here, which you could see. So in 2013, it has done as good as 37%, but in 2016, it has gone as 7%. 2018, the return was nil, but in 2020, the return was 49. Yes, the index has been slightly volatile. There's no doubt on that. But what is trying to see here, if you pick up any index, any economic index, you pick up Nifty 50, you pick up S&P 500, if you pick up Nifty 500, you will see this kind of volatility there. The point which I'm trying to show here is key. If we look any data around here, like if we go back now and we see, and we always talk about how you would have earned return if you had invested in 2008. So you see a lot of people talking about if you would have actually invested in 2008, you would have earned like 50%, 60%, or X number, which is exponentially good, right? But if you imagine yourself in 2008 scenario, many people actually took out their money of those scenarios, and instead of investing, they were running away from the stock market. But sitting in the future, sitting in 2022, we know that investing in 2008 would have held a portfolio on an exponential return. Similarly, today we are worried of all the noises which are around about the US. The interest rates are rising there, and there is Fed taking aggressive actions. There's CPI is getting higher. There's oil concerns, energy concerns with Russia and all. So a lot of noises. We know people talking about recessions and all. But if we, and then down the line, 10 years now, we will give example of what would you have earned if you have invested in 2022. Because this year has been a very difficult investing years. We have seen even by events, and which has actually led to market fall down. So maybe this looking at not looking it as a negative return, but actually seeing it as an opportunity could might 10 years from now you will see that yes, you have done or if you feel like you've missed an opportunity in 2008, then this might could be another opportunity to invest in. But that is from a single Nasdaq perspective. But if I look at in comparison from Nasdaq 100 to S&P 500 and Nifty 50, so what I have done here is shown you and returns in comparison of INR, because we get a benefit not just by what Nasdaq 100 is only, but by the currency depreciation also here. So something in 2013, which was looking like 37% there, is now looking like 54.60%. It's just because of the benefit of currency depreciation. So you know, every time the currency depreciate, and in difficult times, whenever India face something difficult, the currency depreciate more. So currency depreciation will always be there. We know that for a fact. It might move up and down a bit, but in the long term, we have depreciated historically. And that benefit could have been a positive impact on the Nasdaq 100 returns, and whether say S&P 500 index return also. I have put on here the 10 incidents there, and the green one highlights the one which has earned the maximum. So in the last 10 years, actually Nasdaq 100 5 times have outperformed S&P 500 and Nifty 50 here. So That's the diversification benefit of it good, because if you have an exposure to Nifty 50, maybe a little exposure to Nasdaq 100 will give you better diversification across the portfolio, because different economies goes through different phases. Some economies, my US is getting a little more impacted in this scenario. Maybe in down the line years another event come up and India might get a little more impacted than US. So every economy take an event in a different way, they get impacted in a different way. So just diversifying your portfolio in a home based might increase a risk to your portfolio, but a diversifying across the geographies might actually give a benefit there. Now, when I'm talking about diversification, and at the point I started with, which is the exposure to financial sectors, there's a number put down here, it's like how much exposure to financial sectors this indexes have. If I talk about S&P 500, it has 10.95% of financial sector exposure. A Nifty 50 at 36.8% exposure here. So one thing is, any which ways have a lot of financial sector exposure there. But what important is to take advantage of the sectors which are actually are the new sectors to the economy, new contributors to the economy, and which Nasdaq 100 is purely can help out with. Similarly, if I see the correlation in respect of this, and because of non-financial sector, the correlation is slightly lower here, and which is actually creating actual diversification to the portfolio when the two indexes or two securities in your portfolio have a lower correlation. So let's say Nifty 50 or let's say Indian indexes have 20 to 22% of correlation with the Nasdaq 100. So that gives you a true flavor of diversification in the portfolio. So all this about like how performance and how it has given you benefit of diversification. But having said that, the main question I think all of you were thinking and might want to hear when you're joining this call is why US now, or why I should invest in US now at this point in time. So that's what I'm going to address in the coming slide. The first point I want to address here is that because, like I've given you an example, that we always look back in the history and say that you missed an opportunity there. But when that opportunity is arising, there are a lot of noises around, and which actually lead to not many people investing in that in the stock market that time. And maybe this is the time, or maybe this is part of the time when there is a lot of noises around, and investing looks very risky here. But maybe this is the point where the market has actually gone attractive. You can see that the PE line, which is a gray line here, has actually come down drastically, and it is 23.29p. That is Nasdaq 100 is trailing it. From 40, it has come down to 23. Like, so that gives you that indicates you that the valuations are very attractive here. And along with this, if I look back and put this index into different scenarios, you will see that indexes fall down majorly. Like indexes fall down by minus 49%. Indexes fall down in COVID at 28%. But the recovery which you see from here is again drastic. So minus 49% was recovered in a year with 83%. Minus 28% in COVID times were recovered at 85%. So that's the benefit of investing at the low point, or when the market is literally falling down or at a downside. That's the benefit of investing, because if you look at the 1 year or rather more long-term prospect from there, you will see that the market eventually recover because of the strong fundamentals there. So when I talk about Nasdaq 100 here, the one thing I want to highlight here is the Nasdaq 100 evaluations over the year. So index over the year has gone strong in terms of fundamentals there. Like it's debt to EBITDA ratio has improved. So now it's like 36% times better than what S&P 500 is giving. That is Nasdaq 100 is at 1.5. So that much cash it has to actually pay back his debt. So even in this volatile time, you could see the fundamentals getting improved here. And again, just to compare the scenario, like we were talking about the historical scenarios here, we have picked two scenarios specifically to see that how it has done in those scenarios. The first one is when people were talking about the recession, like people are talking about it now. So it was 2007 to 10 period, 3 years period which we have taken. You will see the index has fallen down quite a bit in a matter of a period of time. And the similar situation you can see now, the index has gone down by like 21% now. But then in 2 years, recovery from here has been an exponential, which says that if the fundamentals of the companies are strong, the market impact will be there definitely, but then that there's a potential to recover from that impact. Similarly, if I pick up 2015 to 19 type scenarios and I see that when the Fed was rising rate at time, again the index has seen a drastic fall in 2018 types, but again there was a recovery from there. Just to put on a point that when the fundamentals of the companies are strong, so like Nasdaq 100 is also companies like Apple and Google, which are good with the cash flows they have. So when I say like there's almost if I have to say that 59% of cash to pay back your debt obligation as an index as a whole. So when you have such a huge cash cushion, even if there is an interest rate rise, even if the cost of capital is going up, you know that you'll be able to pay back your debt, or rather take advantage of this rising interest rate. Maybe if the valuations are attractive, these companies could come up with the strategies which could help them out, like buybacks or strategy acquisition and all. So when the companies have a good cash balances or cash cushions with them and a strong fundamentals to pay back their debt, they could actually help them when the market falls and come up with a strategy which benefits this industry. Now coming down, talking about all about the Nasdaq 100, and so boiling it down to how we are coming up with this and how Access has placed Nasdaq 100. So we have come up with the FOF, Access Nasdaq 100 FOF here, and which benchmark is going to be Nasdaq 100, and it has an exit load within 7 days. It has a 1% exit load, and after 7 days it's nil. The fund manager is going to be Hitesh Das. The one key point which I want to highlight here is most importantly that what we are doing is investing in the top overseas Nasdaq 100 ETFs. Since it's a FOF, we have three options of ETFs to invest in, and all three of them have their own global expertise. Be it Xtracker, be it iShares, be it Investco, they all are global expertise which will have much more which have much more lower tracking errors and better execution capabilities than what an Indian market could execute. So maybe that is one point to note, that if you're investing in a US market, investing gets slightly difficult here, and hence which could lead to higher tracking error. But while going with an FOF, what we could do is we can avoid that scenario, go with the expertise who have like huge AUMs to invest in, and we will just putting in some drops in them which will get in a better executed because of the capabilities they have. So that's how we are positioning it, and that's how we are coming up with an FOF and not an ETF. That's from my end, and I'm happy to answer any questions there.
All right. Thank you, Shikha. I think that was great. Thank you for your insights. This is for the ladies and gentlemen who've joined us this evening. There is a question box available on the player. You may go there and type in your questions, and we'll have Shikha answer as many of them as possible. You will also see there is a link where you can actually visit our website and know more about this product, read about the details, the statutes, etc. So, Shikha, without further ado, what we'll do is we'll look at a few questions that have already come in from the participants today. Now, the first question that says that considering global volatility, why should one consider investing in the Nasdaq now?
Okay, so that one thing, the corporate volatility is already there. We know the scenarios in across the globe, not just the US. The Europe is also getting impacted. India is also struggling out here, and we know that the US is also struggling with a lot of events that is happening around the globe. But one thing which I've highlighted in the presentation, I want to emphasize it against with all the noises. What one has to look the strong fundamentals of the companies which they are investing in. So maybe if I look at this index as of now, I know that its debt to EBITDA ratio is good. I know that its debt to market cap is it's like 26% higher than the S&P 500 is another US index, and I know that the companies there has a huge cash cushion there. So almost I think in I think the first quarter of this year, the Google had around $440 million of cash, and it has to pay back the interest of only 48 billion dollars. So that's how the strongest companies are, which is investing in it. Plus, we know that the technological advancements which are happening and the adaptivity we have for that. We know that we're going to go with, self-driving models. We know the build up on the AI systems. We know the build up on the big data, how much they are advancing on. So we know that this company has a strong potentials there, strong fundamentals, and the demand of the cloud services, which are increasing day by day. And the IT, see, technology is a volatile sector undoubtedly, but looking at the scenario, we know the demand in the long term is going to be there. So, because when you're investing in a global funds, even in the domestic sectors, we do say that, invest in for a longer period of time, at least 3 to 5 years is where the equity plays. So when we're talking about the global equities, also the similar things apply. That look at the long term from here and not just the short term there. So you will know that in the longer term, these companies are going to do well. This index is going to do well. One, and then again, this index bring a major diversification to the portfolio as well. So you have the capital depreciation benefit here. So something which is negative for you because your currency is depreciating, and hence you end up, paying more for the stuffs or services for the stuff. But here you'll get an advantage instead of it. So that's one, give you global exposure there, and not just the US exposure. You know the Alibaba which is there. So Alibaba is China company, but it's listed on the Nasdaq there. Why? Because of the advantages the US provides. So the domicile is not just the US for them. The revenue is all over the world. The Amazon revenue is from India. Google, how much do we use? So revenue sources are also, globally diversified there. So looking at these scenarios, I believe that at this point, even though there are a lot of noises, but the market has come down by minus 21%. And I know the things have not gone better here. We are expecting further rate hikes from the Fed. But if you see, let's take an India example. What happened in COVID? The COVID actual impacted, which come on us was like later in May, June, July, August type of. But the market has actually fallen in the March. So market always discount all these events well in advance. So all these rate hikes which are happening, all the Russia invasions, energy crisis, which all are there, this are already getting already getting discounted, or might have already got discounted in fact in the Nasdaq 100. So maybe if you're looking for an entry point, you want to, this could be one of the opportunity to enter into Nasdaq 100 here, and hence like that's is one of the reason we are coming up with it now.
Fair enough. I think you made a few really great points. Another question, a very valid one actually. I've seen this repeated a few times here. What are the benefits of adding Nasdaq to your portfolio at this point of time? And is this your bet to diversify your portfolio? So I think a few people are interested in diversification. So could you probably help our customers understand how this product can help them diversify with both, say, the Indian and the global markets?
Sure. So when I say diversification here or the benefit here, so diversification is one of the benefit that Nasdaq 100 could give you. So the three things which gives you diversification here is one, in the prospect that it gives you geographical diversification. As I've mentioned that 50% of revenue does come from US, but rest of the 50% is from around the world. So this company is not going to just get impacted because of the US falling down. Maybe because of the other countries are doing well. Maybe because India is doing well. The Amazon revenue from India, or the Apple revenue from India will still be there. So these companies will, will obviously when the economy goes down, companies do get impacted. But the rate of impact is what matters as of now. So that's where these are very fundamentally strong companies which are large cap. So, when I said the first word, it's 100 large cap non-financial companies. When I say large cap, it's a market cap. So in India also we believe that, you see, we know that when the economy go down, Reliance will have an impact, but it being a large cap company, the impact will be slightly lesser than what small or mid-sized companies will have. So again, this is a large cap index. So that benefit of that will always be there for that. Okay, one impact could be slightly lesser because they being a large cap fund, and they giving a revenue source from across the world could be another benefit there. Plus the being, and we have an additional advantage of being in India, that if you invest in US, your capital depreciation, your currency depreciation will give you an add-on. So in one of the slides, I tried and showed that even though in 2013, 39% appreciation was there in Nasdaq 100, but when it counted in an INR term, we actually seen in above 50%. So that kind of depreciation benefit, and we have already currency has depreciated. We have been going around and around by 78 to 80%, 80. somewhere around. So this kind of benefits will add on to the Nasdaq 100. Plus, one thing which one of the features which I want to highlight again, that if we look at our portfolio with a lot of financial sector exposure we have, and it's with every one of us. We have HDFCs, we have ICICI. I should not name them, but big companies we all have in our portfolios. We have that in our funds as well. Across the mutual funds, you have it in your portfolios. Even though you invest in indexes, they are heavy on the financial sides. Our first goal is financial companies in general. But when you look at your portfolio, then you should know that diversification is not in just of 10 different scripts or 10 different funds. But diversification should actually come from the variations in the correlation. Your correlation should be lower there. Your sectors should be diversified there, and your geography should be diversified there to make your portfolio actually diversified, truly diversified. I will say that. So that's how I think I'll place Nasdaq 100 to give you a diversification benefit, to give you an exposure to global markets, to give you companies which actually have a disruption technology. So now everyone is talking about the metaverse, but now we just get a benefit of it getting people actually adopting it, because till now we have not actually adopted it, but we know that like we adopted Facebook, down the line 10 years we can't even imagine what we'll be doing without metaverse there. So we can't even imagine about now, the EVs, how EVs are coming up nowadays. So down the line, if you look back at the 5 years, EV was nowhere. The adoption is really fast. And if you look at the AI and the big data, it's a big deal now. People are working that service sectors is improving on that side. So when we all can see it, this is what we discuss on day-to-day basis, and this is what we read about on day-to-day basis. Because these are the sectors which are growing from here. Then why not take an exposure there and get advantage of those sectors actually growing? That's the concept behind this, and this is the actual benefit, I would say.
Fair enough. Thank you, Shikha. Another couple of questions. I'll club a few in the interest of time. So a few customers have asked that a lot of other mutual funds have discontinued SIPs and lump sum investments in foreign equities due to some SEBI regulations. Do we foresee any certain impacts that may regulate the inflows that we are taking into the Nasdaq 100 fund of fund? Would you be able to throw some light on that?
That's a really good question. I actually wanted to cover it up also. So basically, SEBI has come up with a regulation wherein it has at industry level, capped the global exposure to $7 billion, and then for ETF they have given a special limit of $1 billion. Sorry. So basically, what happened is even with this regulation, many of the AMCs which are huge exposure towards might have to close. But we are coming up, and the Access Nasdaq 100 has a limit of like. 100 million dollars. $100 million is a limit for us. So that's a huge potential to here, and we are actually ready to explore the entire limit in this fund. So anyone maybe look at this an opportunity to get the open doors to invest in a global fund here. So the limit we have is exponential for us, and we are ready to explore it. Maybe this looks like an opportunity for market to invest in.
Great. I think the people have already taken a liking to your diversification illustration earlier. So a similar question to that says that what are the benefits of investing in the Nasdaq 100 versus investing in the Nifty 50 stocks or similar high value stocks in India? What would your answer be to that?
See, it's very good that people are comparing it with India. But even if we do talk to clients, even we do frame our portfolio, we always ensure that we have some growth stocks, we have some value stocks, we have some large cap, we have some large and mid cap. And then now that the doors are open, we have advancements, we have the opportunity to invest across the globe. Why not think of getting a diversification furthermore and take an exposure there? Like we use Facebook day to day, we use Instagram day to day, we use WhatsApp day to day there. We all are fan of Apple, but Apple keep on releasing new version with some differences. So we all are big fan of that. So why to put your money there and not put your money to let it grow in that company? Right. So India has a potential but has a limited, because a lot of these advanced companies, disruptive companies, are not listed in India. And if though we are using all those services, we are not able to invest in it. So Nasdaq gives you a way to invest in those. So that's what I'll say. Keep that in mind. So most diversification. There's no comparison. India is better or US is better or something like that. Any which ways, all of us have a lot of exposure in Indian markets. Why not diversify and take an exposure to a Nasdaq 100?
Fair. I think we're into our last couple of questions, not too much to go. So, uh, a question here is Axis has multiple global funds and index funds on offer. So, how does this scheme differ from the existing funds that we offer?
See, Nasdaq 100, as I started with, has its own benefits to it. So we have a couple of more global funds. We have great China funds and all. But when you see this fund, you will actually realize that it's not just a global fund. It's not just taking exposure in US. It's actually taking exposure in the companies which are doing a disruptive tech and which are actually forward thinkers there. And that's where I will place this. See, we have a lot of funds there. Where you have to invest is to pick like what kind of benefits you want to pick up with. So maybe you want to take advantages of something which is getting disruptive, take a Nasdaq 100 there, and that's how I'll position it. It's a non-financial US based company, getting exposure to disruptions, investing in the companies which are coming up with the new thinkers or deal breakers or game changer kind of. So that's where I will place it. If you're willing to take advantage of something which you know we are going to use in future, which is growing in the market, that's where the Nasdaq would actually place around, and not just a global exposure there.
Okay. Thanks, Shikha. Now, a couple of questions again, I'll club. Uh, a lot of customers are asking if this is the right product to start an SIP in, or would you recommend a lump sum investment? Also, they ask that if they already have an existing investment with Axis, can they switch into this fund? Would you be able to elaborate on that?
Yeah, sure. So one thing I want to say that SIP or the lump sum is always an individual choice, like how they want to invest it. If you're confident enough, ki like this is the time you should take an exposure to, you can go with lump sum. If you're still hesitating and you want to keep your portfolio diversified, maybe you could go with SIP. But the good part here is that the lump sum here starts with the 500, and there's an add-on to that and 100 rupees. So lump sum is very small amount. So even if you're looking for it, it's a very good thing that you do not have to invest like a standard 5,000 earlier. It's just slightly lower this time. So maybe you could look at that. And SIP is always, see, SIP has its own benefit of, rupee cost averaging there. So that benefit no one can take away. But since there's always a limit and the market which we're seeing right now, maybe you could do both. Maybe put a little bit on lump sum because the lump sum amount is not huge, and then later on start an SIP. So depends on how your portfolios are doing well in that. So that could be like a strategy which you can form based on your portfolio.
All right. Thank you. Uh, I think we have a couple of similar questions. Again, I would recommend the ladies and gentlemen to visit our website, to reach out to us on email or call us, and we'll probably be happy to address a few more of these questions. In the interest of time, Shikha, probably last question for you. What would be the taxation aspect of this fund, given that this is a global fund of fund? How would an individual be taxed?
So it will not be taxed on equity, even though it's equity. Any global funds are taxed on that basis. So any residential individual will be taxed on 20% indexation for long term, and for the short term, it's going to be 30%. So this is the standard of what every global fund have, which is going to be followed by this. But you can always have a deeper look with your taxation on that.
Fair enough. I think, Shikha, thank you. You've been really patient and helped answer a lot of these questions. What we'll do is, again, we'll go ahead and close the session here. I'll thank the ladies and gentlemen who've joined us for joining us on this Friday evening, and probably wish you a great weekend. Stay safe. And yeah, over to you, Shikha, if you'd want to conclude.
Thank you everyone. For any queries, as Siddharth said, please visit our website. And thank you everyone for joining in, especially spending your Friday evening here. Thank you.
Thank you.
Mutual
Bye-bye.
fund investments are subject to market risks. Read all scheme related documents carefully.